Hey there, and welcome back to Legend Finance. If you're in your 20s or 30s, investing might sound daunting, but it's a game changer for your future. From stocks, bonds, and real estate to mutual funds, retirement accounts, and even self-investment, there are a ton of options out there for you. Remember, it's not just about what to invest in, it's about your goals and your comfort with risk. Start thinking about what works for you and take the leap into the world of investing. It's never too early or too late. Don't forget to hit that subscribe button for more finance tips and strategies. We're here to help make your money work for you at Legend Finance. Index funds. Let's talk about investing. Index funds and stocks can be a solid choice, especially if you're under 40. Yes, they carry risk, but they also offer some of the best returns. Investing is a journey. There's room to learn and grow. And remember, even when dealing with high stakes, thoughtful and calculated decisions can make a world of difference. Consider this. Stocks have averaged about a 10% return, using the S&P 500 as a benchmark. Not too shabby, right? But don't forget about diversification. Toss some bonds into the mix for stability. They might not have the highest return rate, but they bring a sense of security to your portfolio. Aim for around 10 to 20% of your investments in bonds, adjusting according to your comfort with risk. And hey, have you heard about crypto index funds? They're relatively new and show promise, with returns currently ranging between 10 and 15%. Keep in mind that higher returns often mean higher risk. The cherry on top with index funds, low fees. The less you're paying in fees, the more you're pocketing in returns. Plus, many index funds provide the added benefit of diversification. Be mindful though, investment fees can chip away at your returns, so it's wise to keep them to a minimum. And don't overlook potential tax implications as you're building your portfolio. Real estate. Let's chat about real estate, a powerhouse in the asset world. Why? Well, for starters, there's nearly always a housing shortage and property values tend to climb over time. The first step on your real estate journey is buying your own home. Not only does it cut out rental costs, but it also sets the stage for future investments. Once you're settled in your own home, you might want to explore commercial properties like multi-unit residences, townhouses, or offices. Now, if jumping directly into the real estate market seems daunting, no worries. There are other ways to dip your toes in. Crowdfunding platforms, for instance, let you start with as little as $500. This pooled investment, along with contributions from other investors, can go towards property investments. You might know these as REITs or real estate investment trusts. It's a way to have a slice of the real estate pie without the need for a full-on property purchase. Education. Did you know your 20s are often considered prime time for learning? Research suggests that during your 20s and early 30s, your ability to pick up new knowledge is at its peak. So why not seize the moment and maybe snag that extra degree? Education is a key that can unlock many doors to career success. But remember, not all learning necessarily leads to a profitable outcome. It's easy to fall into the trap of confusing hobbies with career advancement. When considering educational investment, it's smart to focus on areas that align with your career goals and have a clear pathway to success. And hey, while you're in this prime learning stage, why not sharpen your financial literacy skills too? It's a great time to lay the groundwork for your financial future. Startup business. Thinking about starting a business while you're young? Well, it's a pretty good idea. Businesses can have unlimited returns on investment ROI. You can earn as much as you can hustle. Starting your own venture or investing in one during your 20s can lead to impressive returns. Who knows, you might even stumble upon the next Amazon. But don't worry if you don't strike gold, the experience itself can be priceless. Not up for starting your own company? No problem. You can invest in other startups in exchange for a stake in their business. For instance, you could become an angel investor. This route works well if you trust the founder. Your investment could be a convertible note, which might turn into a loan under specific circumstances. Crowdfunding is another interesting avenue. There are tons of sites out there showcasing promising startups looking for funding. Just make sure you do your homework before investing. Learn about the founders and their story. Look for businesses run by people with the necessary training, experience, or education. Another exciting way to get involved in the business world is through venture capital funds. As an accredited investor, you could become a venture capitalist. However, keep in mind that this option often requires a hefty initial investment and stringent qualifications. Still, if you meet the criteria, it's another great way to be a part of the business landscape. Treasury bills. Have you considered Treasury bills as an investment? They're not just for seasoned investors, but for everyone at any age. In fact, starting young can have its advantages. Here's the scoop. Treasury bills are short-term debt instruments guaranteed by the government and used to fund expenditures and manage the money supply. They come in 3 durations: 90 days, 182 days, and 364 days. We all have expenses, right? Tuition, rent, and those pesky professional exams. Here's where Treasury bills come in handy. You can invest your spare cash in them, and when it's time to pay those bills, you can cash out. It's a strategy known as asset and liability matching, where you use an asset, in this case, the Treasury bill, to finance a future liability. One of the best parts about Treasury bills is that they're risk-free. Your returns are guaranteed, which can't be said for all investment options. Plus, the returns are nothing to sneeze at. So why not give Treasury bills a try? And while we're on the topic of investments, don't forget about growth stocks and dividend stocks. They can be another excellent addition to your investment portfolio. Growth stocks and dividends. Being in your 20s and 30s means you're in prime time to take some calculated risks with your investments. Why? Because even if things don't go as planned, you've got time on your side to recover. One of these high-risk, high-reward ventures, stocks. Let's break it down into 2 types: growth stocks and dividend stocks. Growth stocks are essentially shares of companies that are expected to grow significantly faster than the industry average. They're usually businesses with strong and sustainable positive cash flows and revenues. It's like betting on a rising star. Dividend stocks, meanwhile, are the shares of companies that are typically well-established and financially stable. Their share prices tend not to fluctuate as much as growth stocks, making them a less volatile choice. Adding dividend stocks to your portfolio while you're young can be a smart move. They can provide a consistent income stream over a long period of time, as long as the companies continue to perform well. It's a bit like having a steady part-time job that keeps paying you year after year. So why not consider adding some to your investment mix? Exchange-traded funds. Let's shift gears and talk about ETFs, exchange-traded funds. They're kind of like cousins to index funds. ETFs are essentially baskets of different assets, such as stocks, bonds, and even gold. What sets them apart is how they trade. ETFs can be bought and sold on an exchange just like stocks. This flexibility makes them a handy tool for investors. Want to invest broadly, like in the S&P 500? There's an ETF for that. Interested in a specific sector, like tech or healthcare? Or even a subsector, like social media or robotics? Yep, there are ETFs for those too. Some examples of ETFs include the Schwab US Large Cap ETF, which focuses on big American companies. The Global X Robotics and Artificial Intelligence ETF is a great choice if you're interested in the tech industry. Or if you're looking to invest in renewable energy, check out the iShares Global Clean Energy ETF. ETFs are a great way to diversify and tailor your portfolio to your interests. Commodities. Let's delve into the world of commodities. They're often resources with a high degree of fungibility, meaning the market treats all instances of a commodity as essentially the same, regardless of the producer. So how do you invest in commodities? One way is to buy physical raw commodities, like precious metal bullion. Another is through futures contracts or exchange-traded products, ETPs, that track a specific commodity index. These can be a bit complex and volatile, so they're generally recommended for more experienced investors. Yet another way to tap into commodities is through mutual funds that invest in businesses related to a specific commodity. Take, for example, an oil and gas fund, which would hold stocks from companies engaged in energy exploration, refining, storage, and distribution. Why consider commodities? They offer portfolio diversification and potential returns and can act as a hedge against inflation. In fact, commodities have historically performed particularly well during inflationary periods, making them a solid asset to consider for your investment portfolio. Annuities. Think of an annuity as a contract between you and an insurance company. You make either a single payment or a series of payments, and in return, the company promises to make periodic payments to you, starting either right away or at a future time. There are different types of annuities that serve different needs. Some can be used as a savings vehicle for retirement, while others can convert your savings into a steady stream of retirement income. Some can even do both. A deferred annuity is when the insurance company holds off on payments until a future date. On the flip side, an immediate annuity starts paying you right away, providing a regular source of retirement income. You'll often come across two main types of annuities, fixed and variable. There's also a hybrid known as an indexed annuity or sometimes an equity-indexed or fixed-index annuity. Annuities can be a great retirement planning tool, and they're often pitched as tax-deferred savings products, but it's essential to understand their costs. Annuities often come with various fees, such as surrender charges, mortality and expense risk charges, administrative fees, and sometimes even high commissions, reaching up to 7% or more. So it's vital to get all the details before making an investment decision. Cryptocurrencies and initial coin offerings. Cryptocurrencies and ICOs have recently caught investors' attention, with thousands of options and billions raised. These complex markets can offer huge returns, from 12% to 200%. For example, the ICO OTA yielded a 13,000-fold return. But remember, high rewards often mean high risks, so understanding these investments is key. Thank you for investing your time with us today and for continuously supporting our channel. We hope you found value in exploring these potential assets to consider in your 20s and 30s. Each financial journey is unique, so use this information as a starting point. Do your own due diligence, and remember to consult with a financial advisor for personalized advice. If you appreciated this video, kindly hit that like button and don't hesitate to subscribe for more financial insights. Let's grow our financial wisdom together and create legendary success stories. Until next time, stay legendary.